Assalamu alaikum wa rahmatullah. Hello everyone and welcome again to our YouTube channel Business Mindset with Amin. Through this video today, we continue to talk about the balance sheet and we will focus inshallah to analyze the financial ratios. So what does mean the financial ratios and what are the different financial ratios that the company has to calculate in order to analyze the financial situation of the company. So let's go and we will start with the definition. So the financial ratios as definition is a technique used in a financial analysis to determine how the company are performing. These ratios measure the relationship between two or more components of the financial statement. So here, as definition, we can say that we can determine several ratios of the company in terms of finance. So we start with the working capital ratio. The working capital ratio is calculated by dividing permanent funds. It means permanent funds means here the no current assets. The permanent fund means the shareholders' equity and the no current liabilities by no current assets or fixed assets. It represents the ability of the long-term funds to finance all the fixed assets. It means that this ratio should be greater than 1. So this working capital ratio is the same when we calculate the working capital. So if the working capital is positive, so this ratio will be higher than 1. If it's negative, the working capital is negative, so this ratio will be less than 1. So next, the next ratio that we can calculate is the private financing ratio. It represents the ability of the company to finance the non-current assets, but here by its equity. It means the shareholders' equity. Here we have to divide the shareholders' equity by the non-current assets. The next ratios, here we have the liquidity ratios. The liquidity ratios here we can divide into 3 ratios here. We have the current ratio, the quick ratio, and the cash ratio. For the current ratio, this ratio measures the ability of the company to pay off its current liabilities with its total current assets, such as like inventories, accounts receivable, and cash. It means here we have the current assets. It means all the elements of the current assets, such as cash and cash equivalent, customers, inventories, that include bill materials, products, final product. So here we have to divide this current asset with the current liability. It means here if the company have to buy all these current assets, it means they convert this element to cash. If this cash has the ability to pay the short-term debts of the company, it means the current liabilities. In this context, we can say that the current ratio will be higher than 1. In this situation, we can say that the company has the current ratio. If it's not, so it's vice versa. So we can say that the no current ratio will be less than 1. So the elements of the current assets can't be, the company can't pay the short-term debts of the company. So the next ratio is the quick ratio. So as we say, the current ratio here it measures the ability of the company to pay off its short-term obligation. It means the short-term debts with its most liquid assets. excludes inventories. It means in this context we can say that we can take in consideration just all the elements of the current assets, but here we exclude the inventories, means the raw materials and the goods or the final products, and we have to divide these elements with the current liabilities. So in this context we can say that the company here or this ratio, we cannot compare it with one, but at least that these elements of the current assets can cover 67% of all short-term debts. The next ratios among the liquidity ratios is the cash ratio. It measures the liquidity of the company. It means the ability of the company to face the short-term obligation, but here we just with the cash and the cash equivalents. So here we take just the element of like the bank or any element that the company can convert this element into cash in a short period. Now we move to another ratio. So here we have seen the liquidity ratio. Now we move to the profitability ratio. Here we have two major ratios. We have return on assets, ROA. It measures how efficiently the company uses its assets to generate profit. Here, this formula is we can take two major elements: the net income and the total assets. Another ratio, profitability ratios, we have the return on equity. So the return on equity, it measures how efficiently a company is using its equity to generate profits. So here we compare the net income with the shareholders' equity. Another type of ratios is the financial leverage ratios, and we have here we can have the debt to equity ratio. It measures how much company is funding its operating by using borrowed money. Here we compare the total liabilities with the total shareholders' equity. The total liabilities here, we just take the no current liabilities and the current liabilities. It means not all the total liabilities, means the table of the balance sheet. Here we don't take in consideration the shareholders' equity. We just take the no current liabilities and the current liabilities, and we compare it with the shareholders' equity. Another ratios among financial leverage is the equity multiplier. Equity multipliers is kind of ratios that measures how much of assets are financed through the shareholders' equity. Here we compare the total assets with the total equity. We can have also we are still in the financial leverage ratios. We have the total debt ratios. It's calculated by dividing total debts, the loan and the short-term debts of the company, by its total assets. This ratio indicates the percentage of assets which are funded by debts. So here we have the total debts and we compare it with the total assets. As we said before, that the total debts contain the short and the long-term debts. We have also another ratio is the financial solvency ratio. Here we talk about the solvency, and the solvency, it measures the ability of the total assets when it will be liquidated or converted into cash to pay off the long-term debts. This ratio must be greater than 1 in order to say that the company has the financial solvency. And we can calculate this ratio by comparing the total assets with the long-term debts. Here we can compare the solvency with the liquidity, but the solvency is linked to the long-term debts, but the liquidity is linked with the short-term debts. So thank you for watching this video, and we will see you next time, inshallah, with another video. And